we just heard some comments from our panel, sort of inside the industry, the inside baseball of the CrowdCheck, the crowdfunding world. Our keynote speaker, Greene, is going to provide, I think, sort of a broader perspective from the small business world. Mr. Greene is the Associate Administrator for Investment and the Special Advisor for Innovation at the United States Small Business Association. He's responsible for both the Small Business Investment Company Program, which is a capital growth program with about $16 billion in assets under management, and the Small Business Investment Research Program, which is one of the government's largest innovation programs, which provides over $2 billion in R&D funding to small businesses each year. He also leads the SBA's efforts focused on stimulating high-growth entrepreneurship and has been one of the leaders in the current administration's Startup America initiative. Mr. Greene also has 20 years of experience as an entrepreneur, investor, and business strategist. He was the founder and CEO of Away.com, an online travel company that he sold to Orbitz, and he was also a co-founder of Rock Creek Ventures and Launchbox Digital, a seed-stage investment firm in Washington, D.C., and he also was previously a management consultant with McKinsey & Company. He received his undergraduate degree from Princeton and holds an MBA from Yale. So please join me in offering Mr. Greene a warm welcome to our podium.
I hear Mr. Greene, and I think my father's going to come into the room. So I decided not to go with a presentation. Somebody once told me that if power corrupts, PowerPoint corrupts absolutely. I use that all the time in my speeches and always get a few laughs, with the one exception when I said it at a Microsoft Developers Conference. Did not go over very well there. Just for context, as they said, from my background, I come in to this position as somebody who spent a lot of time in the entrepreneurial world, both as an entrepreneur and as an investor. And so I describe it as I actually have an incredibly fun job, right? Because fundamentally what I'm trying to do is to say, how can we bring more entrepreneurial and innovative approaches to helping entrepreneurship and innovation in the country? And so I'm excited to be here. I think the crowdfunding opportunity, while obviously nascent, has the potential both to be incredibly entrepreneurial and innovative and have a substantial impact on entrepreneurs and innovators in the economy. So what I'd like to do is talk, first of all, give you a little bit of context coming from the SBA perspective of what we're seeing in the economy and the environment as a whole. Secondly, then talk about where crowdfunding fits in and why, some of the key principles that we think make it an important part, hopefully, of the ecosystem. And then finally come to, looking forward, where I see both opportunities and challenges that I want, you as the different stakeholders in the community really can engage to make sure that this effort succeeds. So starting back, and again, as I was mentioning to somebody beforehand, at SBA, we obviously have a direct programmatic role to help small businesses through a range of different programs that I won't go through the long alphabet soup laundry list. But in addition to our programs, we see ourselves as advocates on behalf of small businesses. And so, the starting point for all of this is data that I hope was quoted on the earlier panel, and you'll hear 100 times more, is at the end of the day, it's small businesses who create jobs in the economy. 50% of all jobs in the economy are with small businesses. But when you're looking at net new job creation, small businesses play an even greater role creating the bulk of the net new jobs in the economy. So at a time when job creation matters now more than ever, the role of entrepreneurs and small businesses is critically important. What we also see, though, is since the financial crisis, a decline in the number of startups. So there's been a drop of 23%, of over 100,000 fewer startups being created each year. And some research shows, by the way, that young companies and startups have an even disproportionately larger impact on that net new job creation that we talked about. So we see declining startups. McKinsey estimates that decline in the number of startups contributed to about 1.8 million of the job loss that we've seen since the financial crisis. And not only a decline in the number of startups, but a market increase in the failure rate of startups. So right at the time when we need these entrepreneurs most, there is an incredible set of challenges. And as part of the Startup America effort, one of the first things we did was get out of Washington to go listen to our customers, to talk to entrepreneurs, other players in the ecosystem, with a pointed question of what barriers are you facing and what concrete steps can we take to address those barriers. And we went to 8 different cities, built an online platform to get ideas, talked to over 1,000 people. And we heard a broad set of issues, not only capital, human capital, finding customers, et cetera, of problems folks were facing, but access to capital was, first and foremost on many, many entrepreneurs' minds. And when you look at the data, you see that the challenges for small businesses in getting access to capital really are across the entire spectrum. So the traditional bootstrapping methodology that entrepreneurs would take of, borrowing against their credit card, taking capital against their home equity, those have dried up, obviously, in this environment. We've seen a market decrease in angel investing. Venture capital investing is way down. And by the way, it's not just down over the last couple of years, but the venture capitalists themselves are having tremendous challenges raising money from institutional investors. So it's likely to be down for some time. Well-documented problems in overall credit markets and senior bank lending. And then finally, the public markets have decreased as well. So the data shows that what we're hearing directly from small business is exactly right. Wide set of challenges across the spectrum. And so the administration has responded in a variety of ways, many of which you guys have heard about before. On the SBA programmatic side, we've had record years both in our lending programs as well as in the SBIC program that they mentioned that I'm responsible for. We have, Treasury has done separate initiatives to get more credit to banks directly as well as to states. The administration has, the president has signed over 17 different tax cuts, either to go directly to small businesses or the investors who are investing in small businesses. So while we've done a lot, we really need an all-of-the-above strategy to help these entrepreneurs. And so in the Jobs Act, what you saw is a range of specific initiatives, obviously that had bipartisan support, to help at opposite ends of the spectrum, if you will. On one hand, a range of changes that relate to IPOs in public markets, and then on the crowdfunding and the general solicitation side, more at the earliest stages. So the IPO piece we don't have to talk about much. Just quickly though, while some people may say, look at that's for a select set of companies, that isn't really as relevant for the market as a whole. Importantly, it helps bring higher levels of liquidity to the market, which is critically important to investors at all parts of the continuum. And so there are a range of changes on that side. But on the crowdfunding, it really does come into that the bootstrapping piece that again is critically important. So the administration came out and supported the crowdfunding efforts very early on. Again, this was a bipartisan effort very clearly. And I want to walk through a little bit the logic of what we were seeing in the market and why we were so supportive of it. So I assume most of the folks in the audience know the basics, of the crowdfunding bills. We don't have to spend a lot of time on that. Up to $1 million of raising, exemption from accredited investor rules, as well as state blue sky laws, basic protections being put in place, regulation at the platform level rather than the individual investment, protections in terms of how much any individual investor can invest collectively across all of their investments, as well as different reporting requirements tiered to how much is actually being raised. But a few core principles, I think, that I just want to take a couple of minutes and talk about. The first, and it's something that we heard over and over again from the entrepreneurs and the folks in the ecosystem, was, look, we can't have a one-size-fits-all approach to regulation. And, the question of does it make sense to have the same methodology to regulate a 50K equity capital raise as it does a $50 million private placement. And so the principle of saying how can we scale and tier regulation so that we don't just take a one-size-fits-all is incredibly important. Secondly is the principle of necessity is the mother of innovation. Okay, I know that's not the quote, but roll with me on that. What we're seeing is, look at, particularly in challenging times, we need to evolve and let financial instruments and models evolve, in the context of the times that we're in. And so there are lots of questions and skeptics, saying, how will this take off? I think all the folks in the room, many are probably very optimistic, some may be pessimistic. Many questions abound that we don't know. But to the skeptics in the room, I think it's an interesting thought exercise to say, well, when you first heard the notion that we could create an online encyclopedia in which everybody would contribute time and write the encyclopedia for free. You know, people would say, who would spend their time doing that? With high levels of accuracy that, you know, a nature study of Wikipedia found that the error rate was comparable to what you see in Encyclopedia Britannica. When you first heard of that, you know, how many people thought that that model would work, right? Or when you first heard of an online marketplace in which people could take the yard sale-like concept, but instead of selling to an individual, sell it over, you know, over the internet to people all around the world, how many people thought that would work? And then how many people said, well, that's okay for Pez dispensers, but nothing real would ever get sold on a place like eBay. And obviously automobiles and far more. So lots of good reasons to be skeptical, but what we have seen, particularly leveraging technology, is the opportunity to build distributed reputational systems in other marketplaces to address issues of consumer protection in that case rather than investor protection. And what we obviously also see is the explosion of crowdfunding platforms, not on the equity side, but on P2P lending or in the donation model. And one recent estimate you may have talked about in the prior panel, or research that I just saw, was that $1.5 billion of crowdfunding investments had been made last year on a worldwide basis. Now, I haven't evaluated the research to know the accuracy of that number, but clearly this is happening on a very large scale already, albeit in different vehicles. So we're tapping into a demand for a product and, you know, a wide range of platforms who are delivering this product. So there's clearly a there there. And again, critical principle is saying, let's not walk away from the concept of investor protection. That's as important as ever, if not more so in this environment. But are there alternative models and methodologies to deliver on that investor protection beyond just the one centralized, let's go through one regulating body? And then I think the third critically important principle in all of this is democratizing the access to investment, right? And so, you know, historically, with accredited investor rules, it limited or it limits how many people can actually be making equity investments. With Dodd-Frank legislation, that bar actually went higher, as I'm sure most of you know. A compelling opportunity with the crowdfunding model is to democratize that, and particularly for companies who historically didn't have access to those high net worth angels and accredited investors. There's a great opportunity to say, let's, again, open up so more people can invest in aspiring startups and so on. So those are kind of some of the broad principles, but I think most importantly, I want to talk about a couple of actual examples, and I think that the previous panel did this as well, to give real concrete examples of individual companies and how can it help them. So the first one is a company called Emmy's Organic in Ithaca, New York. So this is a couple who are both business partners as well as life partners. I always see that and think, if I tried to start a business with my wife, she would kill me within, you know, a new reason for death of startups. But all the power to them, it's working for them. All right, and they make gluten-free and vegan products and desserts, the snacks and desserts out of Ithaca, New York. They literally say that their business comes from the ground up, right? So they've been building it. They literally started out of one of the person's mother's kitchen. And they used a crowdfunding platform after they had originally gotten a loan from a community bank to raise $15K specifically to hire a designer and to make new non-plastic compostable packaging for their product. From that product, 11 months later, they were able to then blow it out. They got into 1,000 stores. And all of the funding, the $15K, came from their local community in Ithaca. So they got out into 1,000 stores. They went from 4 people to 7 people. So not explosive growth, but these are real jobs being created. And they increased sales by 150%. So again, this is without a pure equity, but leveraging more of the donation-based model. That's one example. The second example, a company called Luminade. These were 2 entrepreneurs who had developed an innovative portable solar technology for portable lighting. And after the earthquake in Haiti, they saw a real opportunity to take their product for use in emergency and crisis situations, right? But they had a model and a prototype, but they did not have the capital to take it to scale. So they had an idea of using one of the crowdfunding platforms to pre-sell 500 units, and then they would also, from the revenue created there, they would also then donate others to charity. They blew through their numbers. They originally, raised 10K in 1 week. Within a month, had 50K. They did the pre-sale to more than 3x the original target. The donations were 6x their original target. And in this case, what they found, not only was that money important to them to finance the build-out of the first product, but it gave them real-life experience with customers who were passionate about what they were doing. And so from their perspective, yeah, the capital was great, but it was that real engagement with customers, not only for those initial products, but for an ongoing basis as they were determining product marketing strategy, et cetera, that was incredibly important. And so different aspects that again are small examples, but how can we let that kind of innovation flourish, I think is really the question. And so, with that in mind, what I'd like to do is just kind of throw to the audience, as we say, so where do we go from here? I see three kind of different blocks or issues. The first is coming back to this issue of investor protection, right? So obviously, as the crowdfunding bill passed, there were lots of questions and concerns about investor protection that were raised, many legitimate concerns. And obviously, the SEC is doing the rulemaking now in terms of articulating how that will happen. I think it's incredibly important for the folks in the crowdfunding ecosystem to be actively engaged in saying, how do we make this work? How do we make it work in a way that will let the platforms flourish? At the same time, provide compelling investor protection. Because for the entire ecosystem to work, this is absolutely critical. And I would encourage the folks in the room who are part of that ecosystem to be actively working, not just saying how do we get more capital out, but how do we build in those protections. So both in the formal commenting on the rulemaking that the SEC does, let's not just let it sit in the Federal Register when it goes public, but actively engage, generate ideas, but also for the platforms and others to be proactive, both in the self-regulation, as well as saying, how is it that we make this work? Because a few badly publicized examples when it doesn't work can do damage to everything as a whole. So how do we crowdsource a robust set of protections for the investors is incredibly important part of what all the folks in the room should be thinking about. A second, I think, really important piece is to say, how do we engage a broader set of potential stakeholders in this debate? So, as I travel around the country talking about a range of programs and a range of different needs, I find all the time that different organizations are in their own little silos, right, in their own little echo chambers, right? So lots of the crowdfunding platforms are talking to each other. Completely separately, I talk to venture capitalists, right? Completely separately, I talk to the community finance and community development professionals. Incredibly important that we get folks talking to each other. So just picking on the community development side, for instance, there are folks who've been working for decades in community development finance, right? CDFIs, microlenders, et cetera. They are very plugged in to the entrepreneurial world and small business world in many underserved communities, as an example. Now, many times, much of that community development finance is focused on affordable housing, right? And so whether it's New Markets Tax Credit or low-income housing tax credit. But there's a strong appetite for many players and stakeholders to say, how do we leverage their relationships, but with more of a focus on getting capital to small business? Now, in general, that's taken a lending orientation. Why can't it take a equity orientation? Why don't we connect people who are plugged into those communities, knowing the needs of their constituents, et cetera, to the platforms who can enable, right? So let's make sure those kinds of conversations are happening. And then thirdly, I think it's incredibly important to recognize we're in the early days, right? There are many questions of how could this evolve from here. But to look and say, let's look at a variety of different axes that this could take off on. So the two examples that I gave before. One is a focus on customer-based crowdfunding, right? by the way, and I'll throw this out to the group to crowd fact check if that's a word. I think Ben and Jerry's may have been one of the very first examples of actually customer and community-based crowdfunding. And I know I've seen their story. They raised $12K initially, and $4K of that was debt. But I'm pretty sure I saw Ben or Jerry, in an interview once upon a time, that they literally reached out to customers and members of the community to get that. So I don't know if there's a past, statute of limitations on any SEC violations they may have made along the way. And this is again not corroborated, so I'll throw it out to the crowd to confirm that that's a fact. But those models of saying, let me reach out to a community, let me reach out to my customer base that may not just be in the community, potentially very powerful. Separately, the notion of taking affinity-type groups who may be on a broadly distributed basis. But historically, angel investing, friends and family kind of investing has very much been a local kind of thing. But how can we use a broadly distributed affinity group to do crowdfunding? And finally, a sector that I've been spending a lot of time in called impact investing, in which the view of the nascent impact investing world is, look, there are opportunities to invest, not only for financial return, but where there's a social return over and above the financial return. And you see this happening in a wide variety of places. Clearly, internationally, it's taken off in the world of microfinance, et cetera. But a huge level of interest in the U.S. for this. And again, sometimes it's community-focused, of saying, how do we get more capital into underserved communities? In many cases, it may be sectorally focused. In sectors like education, clean energy, healthcare, healthy eating, again, where there's a social return over and above the financial return to be earned. So there are many people in the impact investing world saying, how do we get more capital out to the companies who are doing this work? And at the same time, here we have a platform that could be a potentially powerful enabling vehicle to bring that together. So more creative thinking like that is needed. And so to close, I want to point people to a great article I read in the New York Times. So Rob, do I get bonus points for throwing up the name New York Times during my speech? It's by Robert Schiller. And I don't know how many of you know Robert Schiller. He's a Yale economist, Case-Shiller Index of real estate activity. He's the Schiller. So here's a person who has been a vocal critic at times of the exuberance of financial markets. And he literally wrote a book called Irrational Exuberance in 2000, which predicted the implosion of the internet bubble and said, look, the fundamentals are way out of whack here. This isn't sustainable. Sure enough, he was right. In 2005, he did a second edition of the book and added a chapter on, you guessed it, real estate, and said, guys, we've got another bubble here. Things are way out of whack, and where problems are coming. Sure enough, he was right. So here's someone who's been very skeptical at times, appropriately so, about different activity in the financial markets. His op-ed in the Times said, actually, let's not discount the power of innovation in financial models to achieve social good. And he points to crowdfunding specifically and gives other examples historically, both from SBA as well as literally the limited liability company, when it was created in the 1800s. But he says the power of crowdfunding to channel, innovative financial instruments to accomplish social good and to address persistent problems that we have in our environment. So there's tremendous power, again, from this platform that we've created. None of us knows in the many ways that it could evolve. We need to do that with the exuberance to say, how do we take this to the next level? At the same time, building in the appropriate levels of protection along the way. So we're excited, within the administration, again, have been big advocates. We've also said the investor protection piece is incredibly important. Would encourage you all to, again, continue to engage. And I guess I've got a couple minutes for questions if that's okay, whether it's crowdfunding specifically or any of the broader things that I referenced as well.
Having worked in the small business capital formation space for roughly 10 or 12 years, one of the biggest issues I see that has to do with small business has to do with the issue of transformation. Making And I think the incubators have really got this down correctly. Vis-a-vis the hub in San Francisco, where they provide a great deal of services to enhance the issuer in the form of valuation or market studies or just providing space, as well as the capital. I personally believe that those services for this industry to work as a whole need to be available. And I come from a skeptical background when it comes from the SEC. I don't know if they quite understand that, because after, again, 12 years of working with the SEC, they seem to operate in a certain space, and how are we gonna really educate them to the point where that this transformation part of it is very important, the nurturing, the building of the business, and the ancillary services that are needed there. Yes.
So a few perspectives. One is I absolutely agree that financial capital is critically important, but it's only a piece, and the broader set of human capital issues, mentoring, et cetera, are critically important. When I invested in companies, I would tell them that my capital is the least important part of the equation. It's the broader set of things we can bring. And the entrepreneurs would always say, yeah, that's great, Sean, just write the check. Right? And then a year later, they may come back and say, oh my God, now I understand what you meant. So that's absolutely right. What we also see in the market is that there are a wide range of organizations and models for delivering those range of services, right? So CDFIs have technical assistance models. There are a whole different set of accelerators happening, some at universities, some privately, some publicly funded, who are delivering those services. The Greene model in the microfinance world is to get the entrepreneurs to build a support network and to counsel and help each other. So critically important. As it relates to this, I think that, and the SEC, I don't know if those are necessarily SEC kinds of issues as much as for other stakeholders in the ecosystem to say, hey, capital isn't the only piece. We have to make sure at the same time we're delivering on the broader set of needs.
Let me just say, it's been a lot of those skill sets, though, have been legislatively prohibited when it comes to the equity side of the balance sheet. And everyone knows, I think, understands that effectuating a securities transaction is problematic with regards to the SEC. So, I'm open to ideas. I'd love to hear more about it.
A couple things. One, when you mention affinity groups, I almost laugh because a lot of Ponzi schemes, including mailers, have that as an important element of the fraud. And also, I talked to Sara, and I've been hearing here a lot of what you're expecting is this is going to be small business and local. Let's take the example that I live in a neighborhood that doesn't have a dry cleaning shop, and somebody comes up to me and my neighbor says, hey, give us some money for capital. We're going to start a dry cleaning shop. And I'm thinking, okay, this is a one-time thing when I invest in a CD. This is a one-time thing when I invest in mutual fund. But the chances are good. That dry cleaning shop is going to probably come back to me in a year and say, well, we ran out of money to keep this nice dry cleaning shop in our neighborhood. We need more money from you, and we might need it again. How do you get that word out up front? That this may not be just a one-time begathon.
Well, I think the education component of this is critically important, right? So that small business investing is risky, right? And I think that's one of the fundamental questions as part of the investor protection. And I think the real question is it's most likely the platforms who will have a primary responsibility for education. So again, rather than saying, I know all the answers, here's how it should be done, I come back and say, all the folks in the room and the folks who have been doing this investing, how do you build those right education vehicles to address that specific issue? Say, what are failure rates of small businesses? What is the likelihood of the need for follow-on financing, right? What does it look if someday you want to raise venture capital? What does that mean to a common shareholder, et cetera, et cetera? Lots of the information is out there, right? None of this is new sets of issues. but how do you aggregate that and distill that so new folks coming into the system can understand those risks? Critical part, education, critical part of that investor protection piece. But again, just writ large, I'm not going to be the one for all the answers. You guys are, and so I think you guys know these issues. This is part of what I refer to as the stakeholders in the ecosystem have to say, how is it that we're going to make this work? Isn't that better than saying I'm from the government and I'm here to help? Yes.
SBA, right?
Yes.
I saw an email last week about the Innovation Fund, $200 million matching funds. Can you elaborate a little bit about that and how that might play out with crowdfunding comes? So if a company comes to our platform and they apply and they get vetted and they get through the process and they're raising $100,000, does that mean that under that fund we can make it matching $100,000 from the SBA for that company?
No.
The reason I asked you that question that way is because that's exactly the way it was asked me this morning.
Yeah, great, and important. So this is hitting a different part of the ecosystem, and so I'm responsible for that program and happy to talk offline. So I'll give the quick answer, and anybody wants a more detailed answer, I can give that offline. This is really focusing more on the early stage venture space. So one of the gaps that we see in the market is that $1 to $4 million first institutional investor round, and what you've seen in the venture space as a whole is most funds have gotten bigger and bigger. So now less than 10% of all venture investors are investing at that seed stage. To make matters worse, 70% of it goes into 3 states, California, New York, and Massachusetts. So we have, and that need had been teed up. There were a variety of bills in Congress to potentially address that gap. Nothing ever passed. So we took an existing program, which was our SBIC program, which really operates more as a fund of funds. We don't make the investments directly. People who are raising venture funds, in this case, or growth equity funds in the bulk of the program, raise private capital, we match it, and then they make all the investment decisions. So as a result of this program, the $200 million per year, we're expecting to put that into 4 to 8 new funds getting created each year to invest in these companies. So it's not going to be it's not a direct match. It goes into the fund. And then realistically, it's later stage than most of the crowdfunding because it's a 1 to 4 million.
Now, how would we go about asking the SBA or suggesting the SBA in a comment type that they would do something similar for crowdfunding? I mean, that's where, if the gap is, if you consider it as the gap being 1 million to 4 million, isn't there a bigger gap on the 1 million below, which are not being, because the banks are not lending because of the 80%?
So, great question. They are different gaps. A few things that are being done. One, hopefully, is the crowdfunding platform will address this in a meaningful way. Secondly, the administration has focused a lot on tax incentives to address that. So, for instance, in the Small Business Jobs Act, there was a tax incentive for people who invest in small businesses. There's an existing Treasury provision where they only have to pay 50% of capital gains on investments in qualifying small businesses. In the Small Business Jobs Act, that went to 0 for a short time period.
Can you elaborate that one?
Sure. If I'm an angel investor and I invest in a qualifying small business, there's already something in the tax code that it's 50% of my capital gains I don't have to pay. In the Small Business Jobs Act, we said let's make it go to 0 if you invest by a certain date. Now, the president has supported making that reduction permanent, but that needs legislative activity. So there are a variety of other tools, including tax incentives, that potentially could move that part of the market.
So
now,
any capital, so capital gains on an investment on crowdfunding?
So somebody who invested in the crowdfund platform, or presumably anybody who invested as part of a crowdfunding vehicle should be entitled to this. And this is a series of, you can hold it for 5 years, et cetera, et cetera. But yes, anybody in theory who made it to be a crowdfunding platform would be entitled to that kind of investment. Now, a brand new idea like matching crowdfunding, that would require legislative activity. And we have some folks from the Hill, so speak to members of the Small Business Committee. We're happy to discuss new ideas as well. But let's get the stuff that we have going, across the goal line.
I'm afraid that's all the time we have, but thank you very much.